In December of this last year for $32 million, 124 home neighborhood sold for $32 million, and they state that that is almost a 50% increase over their traditional model of building and selling out a community. So that's the first thing. We now see that both BlackRock, pension funds, and other institutional groups are buying individual houses. And this is what is reminiscent, again, of 2002 to 2007. When we have bond yields that are just astronomically low, and it makes bonds really a problematic piece to keep in your portfolio over the long haul here. And we're talking about with the amount of debt that we're spending and the amount of debt that this administration's forecasting they want to continue to spend, we're looking at bonds not being able to, or we're looking at not being able to have normalized interest rates potentially for the next 2 decades, because the debt in America is not going to go down. And the reason the interest rates now at this point have to stay sub-abnormally low is because we can't afford in America for the interest rates to go up and our interest on our debt to go up and servicing. So we need to keep the interest rates artificially low for the next 2 decades. And that means that bonds and yields are going to have continuous problems, that it's going to have a ripple effect for all of the asset classes like whole life insurance, for example, that are really built off of the yield of corporate bonds, institutional bonds. So what's happening is BlackRock is looking for an alternative way to get and chase yield. And they think, well, housing is a safe bet. But is housing a safe bet when not only you're buying at the top of the market? Because remember, the virus really set the market up to some of its highest highs we've seen ever. So if you're at the top of the market in a place like Texas or a place like Florida, for example, that's a really hot relocation state from some of the higher taxed northern states and western states, if you're in a Texas or a Florida and the market is already overheated based on the virus and the relocation of people out of those states that are high tax to lower cost states after the virus, post-virus, if that's already the case, and then you have a BlackRock group come in and outbid 20 to 40, sometimes 50% higher than what the traditional price would be, one, you're obviously impacting the local residents and the local wannabe residents who want to buy that house at a regular rate. But how is BlackRock going to capitalize if they buy in at a premium at the top of the market? So this looks like for them, it has to be either they're expecting 2 things. One, they're expecting housing to continue to go up aggressively for the next 18 months to 2 years, and they think they'll be able to divest their position while making a profit. Or 2, they're planning on being a long-term landlord, which would be shocking to us, because that's not really what they want to do they want the return, but nobody wants to be a landlord to get it. So this is creating, an even higher demand for the limited housing in the states that people are targeting right now that they're relocating to since post-virus. So it's interesting, but it is very reminiscent of the 2002 to 2007 mortgage frenzy that went really bad for our country. And so what I would say is, let's make sure that we aren't going back into a situation where we're bidding up an ask on a housing market